My name is Ralph Walkling, and for the next hour and 15 minutes, I'd like to sort of have a brainstorming session with this group and then later with the audience. The panel is going to explore topics in corporate governance, including and starting with the research and interest of this panel, and then broadly pursue questions like what can we learn from international corporate governance? For example, those of us in the States are struggling with say-on-pay, trying to understand say-on-pay. But it's been in 5 countries before the U.S. What can we learn from that and other international issues? Norway's experiment in mandating a certain percentage of women on boards is another example. So I'll start by asking each of our distinguished panelists to introduce themselves, to talk a little bit about their research and their research interests and their background. And then we'll follow up with a second and third round of questions, and then we'll open it up to the audience, because obviously we have some governance experts in the audience as well. So first, in just a few minutes, would you briefly introduce yourself, describe your current research interest, particularly related to governance, and let's go in reverse alphabetical order. We'll start with Laura.
Thank you.
Laura starts.
Thank you. So my current interest in corporate governance is related to my past interest in corporate governance, and that's particularly the relationship between institutional investors and the corporate governance of firms. So I have a recent working paper with Zach Sautner and Joseph McCary from the Netherlands, in which we have a survey of institutional investors and their preferences toward corporate governance. And in this survey, we're particularly interested because so much happens behind the scenes that we can't see. So we want to know what they think, as well as what kind of activities that they're willing to engage in. And so in this survey, we ask them about the differences in their corporate governance preferences, their differences in their views, and you can get it on SSRN, their difference in their views between investor protection in the U.S. and investor protection in the Netherlands, because we wanted to choose just 2 countries, and my co-authors are from the Netherlands. And then we also ask them about their preferences in terms of shareholder activism. And we found that the most chosen part of shareholder activism was simply voting with their feet and selling their shares. That's probably not really surprising. But we did find that a number of the investors did engage in activist activities that you wouldn't see because they were behind the scenes. We also looked at the relationship between their holdings and their preferences, and we found that there was a relationship between their holdings and their preferences. Ralph is going to cut me off, so I'll just say very briefly, I have another paper that's a little bit expanded beyond governance that looks at ESG, environmental, social, and governance. And our interest in this paper is in, and this is with Jay Hartzell Studio and Andy Cope, and it's looking at managerial motivations for environmental, social, and governance activities, and also the interrelationship between institutional investors and these activities. And a number of institutional investors have said, we invest considering ESG, and yet we find that in their actual investments they're apparently not investing according to ESG. So it's kind of an interesting ongoing research.
Laura, if I could just follow up with one question, though. Those that do engage in environmentally friendly activities, are they rewarded?
The companies?
Companies.
We did find, I don't know whether they're rewarded for that, but we do find that companies that have higher ratings on ESG have more efficient activities, they have higher ROAs, and they have higher valuations. But this is work in progress, so I want to be a little careful on saying that completely.
By the way, Renee Stoltz helped us file this morning, so sends us a public. Ajay Patel, Wake Forest.
Thank you, Ralph. My work my current work is, again, related to some work I've done earlier, and it really revolves around trying to better understand how the legal environment or a country's institutional environment impacts, in this case what we're looking at is how it impacts, whether it impacts compensation structures. And specifically what we mean by that is there a relationship between the use of equity in compensation, in the design of compensation packages, and these legal factors, institutional factors. So in that sense, it's very high level. We all know there's been a lot of work done linking protection of shareholder rights, the enforcement of laws, to activities, whether it's companies being more likely to go public, companies having higher valuation in these economies. And what we try to do in this current set of work is look to see whether those same factors that have protected shareholders have resulted in environments where people are more willing to hold shares, more willing to hold equity because equity prices are more informationally efficient, whether they result in better motivation and rewards for management, and whether we actually see cross-sectional differences in the use of equity by firms across these different countries. In a nutshell, our results suggest that these institutional factors are very highly significant, and I'd even venture forth to say more important than firm-level factors that have been used by studies using U.S. data. And I'll come back and talk more about specifics on it. In a nutshell, that's what we do.
Thanks, Ajay. Charles? Charles Olson, Delaware.
Mr. Delaware. I started out in this field looking at actually compensation and director compensation, and why directors of equity in a company need to be more effective monitors of management for a shareholder benefit. And ended up writing some stuff a long time ago that suggested directors should own equity. They didn't for a long time, and now a lot of them do, fortunately. Sort of migrated from that into director independence issues, voting systems, looked at proxy, actually not proxy access, something we call now proxy reimbursement. This is an alternative proxy access that has to do with the reimbursement of candidates for board seats who actually win, as a way to open up the election process and encourage institutional investor activism in elections. Though lately I've kind of migrated back to where I started, which is in the compensation front, and actually through the help of an undergrad who's now a grad student, looking at a new form of executive compensation metrics, where initially, for a long time, we've looked at peer grouping and how compensation is done, comparing executives to executives at comparable companies, comparable sizes, which led to all kinds of problems with the gaming of peer grouping and whatnot. This project now published two things, one in a more popular publication, another to be in a more academic publication with an IRC grant, which critiques peer grouping as problematic not only in that it's manipulatable, but also in that it's fundamentally inaccurate in assessing executive returns. That peer grouping, even if it's done purely, will never result in effective compensation, but in an ever-escalating base level. And so the suggestion is to get out of peer grouping and replace it with a new metric based on actual executive performance. So we're developing a metric to look at actual executive returns and create a scale based on that, as opposed to peer grouping, with an idea that that will be a more effective tool for compensation committees to use in ratcheting down compensation and ultimately restoring shareholder confidence in the compensation system.
That's interesting. I want to return to that when we come to the second round of questions, because it sounds like there may be some interesting methodological issues that some of this group might want to also pursue. Marco, let's start with you.
What can I say? Yesterday, I was talking with an Italian friend of mine on my current research projects, and after a while he asked me, what do you have against majority shareholders? And did they do something wrong when you were a child? Because you always do research against them. And actually I started thinking, and most of my research is on expropriation, shareholders expropriation, on wealth transfer from one class to another class of shares, that most of the time the story I put in the papers is that majority shareholder, in a way or another, ends up expropriating minority shareholders. In city-law countries like Italy, where they own 50-60%, when a lawsuit costs you maybe $500,000, $1 million in litigation, in expert witnesses, it's like if you don't have rights unless you have invested 10 millions of euros in a single stock. And sometimes I work as an expert witness and I realize how much money are involved in this expert witness litigation, and at least there are 30 or 100 million invested in one single stock. Otherwise they don't even start. So on the expropriation field, I would say recently I've worked on several aspects. One of these is dual class unification, which are perceived as a very good corporate governance operation all around the world, because you give up the dual class structure, equity structure. You go back to one share, one vote. But whenever you do it, it's not regulated like it's not in continental Europe and Italy, you can do whatever you want. You can buy all non-voting shares before and then convert. In another paper which I recently done, actually, I find something even more strange in a way, that institutional investors have ownership ties with the controlling shareholders, if controlling shareholders of a company are banks or insurance companies, and they vote as their owners suggest them to vote, even if it's not a sincere vote, even if it's not in their interest. And also, conflict of interest are almost never regulated in my country, so whenever a majority shareholder owns two classes of shares, it's always in a conflict of interest in dual class voting. Recently, I'm also addressing a recent European problem at least. In Italy, there are more companies who get delisted than companies which go listed on the stock market. And the listing of a company is so easy to be achieved through a tender offer with a squeeze out that recently the Italian regulator changed the regulation because it perceived pressure to tender. And so the last paper I'm going to work on is to see if the majority shareholder is going to time this delisting decision in order to take advantage of short market prices, and if he's going to influence the short market price with the management before the delisting decision. This is almost over.
Excellent. Excellent. Well, I'll conclude with the research that I've been working on recently, and that's a paper on Say-on-Pay that was in JFQA, basically saying one size doesn't fit all, but that the market did respond favorably to companies where there was weak governance, increased activism, and where boards appeared to be responsive, where they appeared to listen in the past to shareholders. Also work on market anticipation in mergers and on utility mergers in terms of papers that have just come out. And in terms of working papers, this morning I talked about majority voting. Is it a paper tiger? Is there any efficacy in majority voting? Some work on social networks, actually, and trading costs. And a paper with Ellie Fitch and Antron on golden parachutes. If you think about golden parachutes, they're an ideal case for moral hazard. If I give someone a parachute too large, I may encourage the CEO to have a rush to sale. If I give someone a parachute too small, I may encourage unyielding resistance, neither of which would be in the best interest of the shareholders. And so the CEO is really facing a moral dilemma. They're the person that's probably most responsible for the deal going through, and yet they have perhaps conflicting incentives. So we look at the golden parachute and its relation to deals. And in particular, we want to look at the golden parachute as it relates to the moral hazard issue. Not just a 0-1 dummy, but what does the CEO gain in terms of the golden parachute? What do they lose in terms of future salary? What do they gain in terms of parachute? What do they gain in terms of the shareholder pay package? And when we look at those trade-offs and measure the parachute relative to that, we find that in general, CEOs seem to be trading off bid premia to shareholders for their own personal gain. That is, the better off the parachute is, the lower the percentage of bid premia seems to be in deals. Well, now we've sort of seen the survey of the things that we're working on and interested in, and so what I'd like to do now is just jump in with a few topics. And I'll start with Ajay on a question on the legal environment, but then I would like the panel to sort of jump in where they see fit. Ajay, your work with Stephen Bryan and Robert Nash looks at the way executives are compensated under different legal environments, and you've given us a preview of that. But in particular, you find that firms use relatively more equity-based compensation in countries with strong shareholder protections. Could you talk a little bit about the link between the legal regime and the firm's choice in structuring those contracts with executives?
Sure. So going back to being a little more specific about what we do know that the origin of the legal system, whether it's common law or civil law, has been shown to be related to how things develop in the economy. So the number of firms that go public, the amount of capital that's provided by minority shareholders. We just heard Marco talk about civil systems and expropriation issues. So to the extent you're more likely to find the supply of capital from minority shareholders in common law systems, one of the things we wanted to look at is, could that help explain some of these differences we were finding? Another factor we were interested in, besides legal origin, was about the strength of protection of shareholder rights. There have been many different indices that have been used. In a paper that we published with my co-authors, Stephen Bryan and Rob Nash, in Financial Management last year, we had data that only looked between the 96 and 2000 period. We were looking specifically at firms with ADRs. So in that sense, one could say that they were probably more similar to U.S. firms. So if we were going to find any difference and be able to use these legal factors to explain them, they were probably more likely to find them if one could actually get data back from the home countries. We used ADR data, one, because comp data was available. They have to file these 20Fs. We didn't have to get around differences in accounting systems, so that helped. The downside was potentially that they could be more similar or more different than firms back at home. So we looked at common law versus civil law. We split the civil law into French family, German, Scandinavian, and then we lumped socialists together. In a nutshell, what do we find? If you look at English common law countries, the level of equity in the compensation structure is significantly higher than all civil laws put together. So to give you an example, not from from the previous study, but earlier this year, the Journal of Applied Corporate Finance, we published a piece there that actually updates the data through 2008. So if you go from 96 to 2008, the average use of equity by English common law firms was about 45 to 48% over this period. I mean, it's fairly high. It's about 42%. If you look at civil law, it's down in the teens. If you split the civil laws into these four groups, there really isn't a lot of difference between them. So the fundamental question is, why do you have this huge gap? Now, if you look at the time series variation between 96 and 2008, what you'll find is there is variation. It moves up between 96 and 2001 when it peaked. It rises by about 15%, so from about 35 to 50, and then it comes back down by 2006, and by 2007 and 8, it tails off. It goes back, let's say, about 45, 48. So there is time series variation, but yet the legal environment isn't changing. So there's got to be something else that's explaining it. If you go to the civil law or the non-English legal origins, they also vary over time, and it goes from about 5% to about 20% by 2001, then drifts back down again. So there is this huge structural difference that does seem to vary over time, and really the question is why? What can be used to explain the cross-sectional difference, and then since the legal environment isn't changing, what can we do about the time series variation? And that's where the legal factors come in. So we we looked at specifically the strength of protection of shareholder rights. And in this most recent piece in the Journal of Applied Corporate Finance, we used the anti-self-dealing index. In the FM paper, we run the anti-director rights index, the revised anti-director rights index, the self-dealing index. They all hold up, so we just use the one that's most commonly used now. We also looked at the rule of law. So it's not just whether or not you have the laws in the books, how strongly are they enforced? And what we find is the rule of law, the enforcement is really important as well. When we run them individually, they're important. When we run them combined, they're both important. So it's the protection of shareholders and the enforcement of laws that seem to explain a large portion of this cross-sectional variation. And then we use traditional theories that have been used within the US to explain time series variation, and that's where we use more agency theoretic variables, if you want to call it. So we use the standard things. We use proxies for growth options. We use market growth there. We use size. We look at free cash flow. We look at leverage. And what we find is the results that hold up, what we find in the US, do hold up internationally. The marginal contribution, I would say, is smaller using those firm-specific variables. The legal environment seems to be the major factor.
Comments on legal environment? Marco, your work in Italy shows different results than you might see in some other countries, say Germany. Is it the legal environment that's impacting?
You're referring to the dual class unification
Yes.
problem?
Yes, Jimmy, would you please comment on that?
Yeah, because it probably needs to be introduced on the topic. An introduction on the topic is probably advisable. The point is that something general may happen everywhere, I believe, whenever there are two classes of shares with different voting rights, let's say one with one vote and the second class with no vote. If the voting class is highly valuable and much more valuable than the non-voting class of shares, a dual class unification is a dilution of the value of the rights given to the voting right class to the broader number of shareholders. And so one-on-one unification should make the value of non-voting shares go up because they become voting, but the value of voting shares go down because their voting right is diluted on a broader base of shareholders. And the point is that in Italy the voting premium was very high in the 80s and in the 90s, so such a dilution was very much severe compared to many other countries. Unless you were structuring the unification in a different way, rather than doing it one-on-one, you could have asked non-voting shareholders to give up 3 non-voting shares to get 2 voting shares, for example, and give only an incentive to unify rather than making a wealth transfer between the two classes of shares. And what I try to look at, because what I missed before is that I get inspired in most of my researches by personal expropriation I get when I invest in the Italian stock market. So when I get expropriated, I take comfort by getting a research idea for a paper. And I remember that I was holding voting shares and they made a one-on-one unification. I lost 5% at the announcement, and the financial press say it was a good operation, as all the time it says. And I remember, I mean, this is something going on. Somebody is gaining, somebody is losing. At the first point, it would seem strange because non-voting shareholders gain and voting shareholders lose. Typically, it's the opposite in Italy. The majority voting shareholder controls a block of voting shares and expropriates non-voting shareholders. But during this process of unification, the majority shareholders most of the time try to buy non-voting shares block 20, 30, 80% sometimes. We're even giving non-voting stock option plans to the directors on the board. And then, after some months, they were unifying non-voting into much more valuable voting shares. So majority controlling shareholders was gaining, making a gain, or was hedging from the process, while minority voting shareholders, myself, were harmed between 2, 3, 5, 10% in some cases because of the dilution of the voting right. In my opinion, something can be studied only in the Italian environment but could be applied everywhere in the world. In many other countries this doesn't happen. In Germany it doesn't happen. It doesn't seem to happen even if it hasn't been studied carefully, but probably it doesn't happen because you can observe a severe voting dilution by the majority shareholder, which means they were not owning big blocks of non-voting shares. And in Germany, probably doesn't happen because they have less incentive, the voting premium is smaller, and more disincentive in doing it, probably because there is more media independence, so you can get criticized by the media if you do such kind of operation, and probably because there's a higher degree of law enforcement, which in my opinion is one of the most important driving factors against unification, against expropriation, I would say. So in the presence of a low degree of enforcement of the law and media which don't criticize, you have a perfect environment for expropriating minority shareholders.
Charles?
Well, I've never been a big fan of dual-class stock. I think that it's inappropriate on many different levels. I mean, the only argument that you can muster in supporting it is if you have a legal regime that protects the interests of the minority holders, even if the majority holder or the voting holders, do what they need to do. The problem is, even in advanced legal systems, which we have in the United States, you never will adequately protect the rights of the minority. Even in the best of all systems, minorities' rights will never be protected legally. There's a real failure in the legal regime, I think, for protecting minority rights for a lot of different reasons, which is why ultimately I would hope, in the states at least, we move back to a one-share, one-vote system. And I would hope Delaware law, which governs a lot of this, would ultimately say that a two-voting class system is effectively illegal under Delaware law, because there's no real effective way, ultimately, even legally, to protect minority rights. You've got to equate a share with the voting rights. Ultimately, the vote does count, the vote does matter. And I don't think there's any real way to protect the rights of the minority from a dual-class structure. In a dual-class structure, the majority is going to have its way. The danger, obviously, is expropriating minority value to the majority. And even if you have the best-willed majority, the majority, let's say, who dies and passes it on to an inept child, inevitably ends up with minority voting problems. And we've always tried to solve it, at least in Delaware, with very strong anti-self-dealing rules and whatnot. But self-dealing is so effectively done from a legal standpoint that I think it's almost impossible to reduce the impact of the minority, which is why in the states, minority or voting for Class B or voteless shares have a less value. And you can say, well, so what? Someone will buy in, they know that's the occurrence, but not exactly. And ultimately, I think the existence of the system is problematic, and I think we've got to do it. Ralph, this goes back to your point of majority voting. I mean, the idea is that voting systems ultimately protect the minority against majority encroachments. The difficulty is, even where you have a majority voting regime, is that when we created the law to allow majority voting, we did not require the board, if someone attained less than the majority, to leave the board. We actually, I was on the committee that drafted that. There was a big dispute, and some of us said it ought to be an automatic, you shouldn't stay on. The majority of the committee said, majority of the minority, whatever, said that no, you have to give the board discretion. But the board, dominated by a majority holder, will always retain the director who doesn't regain who can't attain him in a majority status. We compromised on this, by the way, by saying that, well, if you keep the person on, you're still subject to a fiduciary duty problem where you go to a Delaware court and say, look, this person did to get a majority, your fiduciary duty is not to keep them on. We were relegated by the committee to a footnote. We had a big argument over that. The lawyers always have great arguments, by the way, footnote, non-footnote. It ended up in a footnote, which was a very hard-fought footnote, one that almost lost because two people left the room to go to the airport. Another story of voting. But nonetheless, it hasn't proven effective because I think legally it's very hard to protect a minority position.
There's no teeth in it.
No. I mean, theoretically there's teeth, but ultimately no.
One of the results I presented this morning in my work with Jay Kai and Jacqueline Garner is that we didn't find much teeth in majority voting, and there were about 14 companies that the directors had failed votes, that is, they didn't get 50%, and they're still on the boards. They also have majority voting, they're still on the boards, because it's at the board's discretion.
Right, which is and that's the problem with that footnote.
Now, Laura, you're on a board.
Yeah.
And probably a majority shareholder in terms of that, the board, Tia Kraft is what I'm speaking of. Do they hold a majority of shares in some companies? Do they worry about the legal regimes? What are the things that you're worried about at the board level for international governance? I've asked you many questions here. Let me make it specific. In terms of international corporate governance, does TIAA-CREF worry about that?
Oh, they're very involved in international corporate governance and domestic corporate governance. They have a whole department on corporate governance and social responsibility. So they have a staff that is looking at this and is trying to affect changes in companies. Now, what I can say from my own research about the preferences of institutional investors is when we ask institutional investors, or what a series of questions on what they were interested in, and these were international, primarily non-U.S. investors, but the 5 things that they were most interested in were, and this gets back to Ajay's thing, 87% thought that equity ownership by managers is one of the most important corporate governance mechanisms. 86% thought that the use of equity-based compensation. And then the other 3 that were the most important were independence of the board of directors, which got 86%, transparency of large shareholder holdings, which got 85%, and then high free float in a company, which got 85%. And they were also, it was about 80% with ownership concentration. So you can see, again, these were mainly non-U.S. investors, mainly European investors. So you can see, in some sense, how the environment had an effect on their preferences when we talk about the transparency of the shareholder holdings and the high free float. I think that's a reflection of where they're primarily invested.
Let's come back and talk about an issue that you raised, Charles, and then I want to open it up to the audience. I'll ask one more general question, and then we'll open up to the audience. And this is proxy reimbursement, because this is something I thought was very innovative that you did on the board you were on. Could you explain to us what this is about? What is proxy reimbursement, and how does it relate to corporate governance?
Yeah, for a teacher, it's actually a pretty good story, because when I was in law school, gosh, almost 30 years ago, this was a fellow, Saul Ledmore, who ended up becoming dean of the University of Chicago Law School. Saul was teaching a class on proxy voting. This was 1981. And he said that wouldn't it be interesting if traditionally, if you run a dissident slate, you don't get any money from the company. He said, wouldn't it be interesting if you pay reimbursement, in other words, getting reimbursed for your expenses and running someone for the board, depending on how many votes you got. If, let's say you got 60% of the vote, you get 60% of your expenses covered. If you got 20, you get 20, et cetera, et cetera. And it was something that was maybe a 3-minute or 2-minute slug in a class, 30 years ago that kind of stuck with me. And when proxy access first came out, which was the theory behind proxy access was really to open up elections. How do we make elections more like elections? In other words, you only have one person running, it's not really an election. But if you have access, it opens up the election process and it creates a more competitive regime. The problem with access is really, number one, it doesn't solve the problem of paying for the contest itself. Because you can get on the ballot, but it still costs millions of dollars to run a campaign. That's the problem with it. And secondly, you've got sort of interest questions. Who gets on the ballot? Does it mean you have to have so many shares? Does it mean you have to have held for so long? And when proxy access was first proposed, the concern was, and it's, I think, a real concern, that if in fact you open the system up, you'd have to have some sort of a filtering mechanism. The mechanism the SEC developed was size of holdings, right? You've got to have 3%, 2% to get on, which suggests that anyone under 3% is a moron and can't recommend anything, which is really problematic for our system of corporate democracy, because the theory was anyone who invests ought to have the savvy to suggest someone. So the question was, how do you create a system that that creates a free election, a la choice, but also solves the question of entry and barriers to entry? And reimbursement says, effectively, and this takes Saul's idea, it says, look, if you win the vote, you get over 50 and get your person on the board, you get all of your expenses reimbursed, period. If you lose by, let's say, a lot, you get nothing, because it means it was a silly contest. But if you lose by a little bit, let's say between 30 and 50%, then you get between 30 and 50% of your expenses reimbursed. Sliding scale reimbursement with effectively a floor under it. And the idea was let the voters themselves determine the adequacy of the contest itself. So in other words, rather than size of holdings impacting reimbursement, let how you actually did. And if you win, you get it all. If you come close, you get something. And if you do really poorly, it suggests that it wasn't a very serious contest. And we thought that that was a way, number one, to solve this problem of who pays for the fight, and B, solve sort of the entry fee requirement as well. HealthSouth Corporation, well, Delaware law, this is some work we did at the University of Delaware. The Delaware legislature met and adopted this proposal. They now allow it at most all Delaware corporations. HealthSouth, on whose board I sit, was the first to adopt it. We have a sliding scale reimbursement policy. No one has accessed it at this point. Maybe they think we're doing a good job. But at some point they may. But then the SEC jumped in, obviously, with proxy access. That put the whole thing on hold. Access has been challenged at the D.C. Circuit. We're waiting to see what the circuit does with it. So, who knows? I think ultimately, regardless of what comes out of the SEC, I think we'll end up, sooner or later, in a reimbursement regime anyway, because I think it's the most effective way to sort out good voting from not so good voting, and really opening up the election process and removing the problem you found with majority voting, where effectively you're voting not affirmatively saying, I want this person on the board, but you're trying to exercise control negatively saying, I don't want this person. And everyone knows from political life, vetoing is not the greatest way to create effective political change.
Have many other companies adopted this, or is yours the only one?
We're the only one at this point because the SEC stopped the show when they adopted Access. Access basically overrides the state law at this point. And at some point, if they throw it out, state law comes back. If they don't, we'll have to see. I think even if it goes through, ultimately the SEC will end up in reimbursement because I just don't think Access works long term.
It's a pretty courageous thing to be willing to fund the people that would overthrow your own board.
Well, look, you got to let the voters decide. If you can't articulate to your shareholders an effective decision, then shame on you. You shouldn't be there. Half the deal, as we do as academics, by the way, is advocating positions, and if people agree with us, terrific. If they don't, shame on them. But if they win, they win. And I think you have to advocate that as a director as well. And by the way, this goes back to the point. Just think, 30 years from now, something you said in a 2-minute slug in your class may end up being in a panel somewhere in Europe 30 years from now. Anyway.
We can hope. Marco, in Italy, are the elections contested very often for directors? How are directors elected in Italy?
Many things have changed actually after the 2005 law on savings, which is the kind of Italian Sabanoxi law in a way. And since 2005 we have at least one member of the board which is granted to minority shareholders. And in order to present a list of potential board director and get one elected, you must own a percentage of voting rights which ranges between 0.5 and 2.5%. The threshold is then set by the regulator depending on the market cap of the company. So largest companies need only 0.5% for presenting a minority list and try to elect one member on the board. What's happening is that since 2005, since this law changed, many UK and American foreigners, hedge funds, activist hedge funds, came to Italy, bought 1, 2, 3% of the voting shares because this small stake was then allowing them to put one person on the board. So the shareholder base changed a little bit. Now a major change is actually triggered by the shareholder directive, voting directive, which just entered into force in 2011. The European shareholder directive is pushing shareholders all around Europe to participate in the meeting more and more by making proxies easier and above all by avoiding the blocking of shares before the voting. So as long as you record as a shareholder 1 week before the shareholders meeting, then you can keep selling and trading your shares, while 6 months ago you could not trade on your shares anymore. And this is changing many things in Italy, as a matter of fact, because in two major companies, one is Terna and the other one is Telecom Italia, which is one of the biggest companies listed. For example, in Telecom Italia, there is a major shareholder with 24% of the company, and a second shareholder with 5% of the shares. The second shareholder was used to be able to elect his member on the board. But after this shareholder directive entered into force, many institutional investors participated through proxies at the meeting and made a coalition to vote their member on the board. And this family who invested $2 billion in telecom was not even able to elect one board member. The same happened for Enel, who was owning 5% stake and was not able to overcome the 10, 15, 20% stake which gathered together from institutional investors, because now they are able to trade on their shares also around the meeting date. And this is changing probably the convenience to buy 4, 5, 10% of shares if institutional investors will be able to overcome you and get the board seat instead of you. So actually things are still changing. And as far as female representation, we are talking about Norway, they just approved a rule so that within 3 years, 30% of the board members must be female. So most of academics are collecting information on how we can change sex in order to keep being on the board again.
Where do I go from there? How do I ask a follow-up? I do want to ask Laura about institutional investing, and in general, we'll ask the board, or ask this group about coordination of institutional investors. Because I've talked with one prominent institutional investor that says, we meet regularly with other institutional investors, but we don't agree on anything. So, does Tia Kraft do any coordination with other institutional investors?
Yes, they do. They're very active in different institutional investor groups. But talking about the differences in how the institutional investors vote, if you just, and some of the members of the audience have actually looked at mutual fund voting, but if you look at different mutual funds, say voting on executive compensation, it's astounding because you find some, such as T.I. Kraft, Janus, T. Rowe Price, that tend to vote in favor of the shareholder proposals on executive compensation more than 70%, 80% of the time, and then you have others such as Fidelity, Vanguard, American funds that rarely vote in favor of these. So just looking at one type of voting, you see very different reactions by the same kind of mutual fund. I mean, the same kind of institutional investor, which is a mutual fund.
Let's open it up to questions from the audience, and then I will, at the end, I'm going to ask our panel to tell us a few things that they found surprising from their own research and work. What have you learned from your own research? What surprised you?
Can I ask a quick question?
Please.
The Italian 30% rule, that's interesting. Is there a rule in the general Italian election scheme that 30% of office holders have to be female?
They just passed some months ago.
So I mean, not on boards, but in other words, if
sorry,
on the in the political process is the same.
No, in the political process, actually, they've been discussing a lot about introducing the so-called quotas, so a stake assured to female. And they discuss a lot, but probably since majority of politicians are male, they didn't pass the law.
So as a shareholder, the government tells you who you own, but as an elected person, you don't. So
that's an
interesting
issue because
so is there effectively a difference between the two? In other words, it's okay in the board process for shareholders to elect, but it's not okay in political.
Which is probably not.
Now, how does that affect political? Interesting.
And actually, also, there's been a discussion on how to enforce the law and how long the process should have taken for companies to adapt to the new regime. All of a sudden, the first ending up of the board mandate or within a given number of years.
So what about a constitutional requirement that everyone from different groups ought to be politically elected too? That wouldn't go over too well.
As a matter of fact, it's not easy to have a clear idea on whether it is right, whether it is wrong, if the percentage of representation should be 20, 30, 40, 50. If you look at population, it should be 50.
Right.
If you look at, I don't know, professional backgrounds, which is due to many other factors, maybe it could be lower, higher, don't know. They just said 30%, but they did not explain why 30% and not 20 or 40. And also, as you're right to say, why also not other categories should be represented? Why, I don't know. So, and on the same time, if you have to assure that they need representation, it's like if you are saying that without that you are discriminating female from male, which is also something that maybe you are not aware of.
But to be consistent, you probably should adopt in the political process too. If the argument is such that imbalanced representation, if that's the case, then why don't you go back to having a committee or 10?
And I would say on the
Maybe
political process could even be 50%.
Well, I know when we end, that's not going to be a surprising finding, that you're going to say, I'm very surprised that the politicians are not following their own advice. But let's open up the audience. Marianne?
Charles, I have a question for you. You said dual class voting is the worst form of expropriation of minority shareholders.
Yes.
But if you look at Google, it has got dual class shares. Or Groupon company, it is going to go public, it's got dual class shares.
Absolutely.
So as a minority shareholder, I'm thinking already those founders have significant ownership stake. I'm not losing sleep that they're expropriating.
Well, let me ask you about Google. It's interesting. Do you know that Google bought a 767 aircraft for its executives? It was a big airplane. That's the one you probably flew over here if you came from the United States. For two people, you know, and they decided they didn't like seats. They put hammocks in. And in fact, the person who was designing the plane for them, they hired a guy, came paid a couple million to put the hammocks in. He said, I feel uncomfortable putting hammocks in a transatlantic billion-dollar jet liner, right? And you have to ask yourself, as a Google shareholder, was that a good use of their money? You know, do they need a 767 with hammocks to fly all? They said, we want the hammocks because our friends are young and they like to be in hammocks. They don't like to be in beds, right? So you got to figure that a lot of money from the company went to that. They also, Google has all kinds of, you know, Google is the largest owner of wind farms in the United States. Did you know that? As a shareholder of Google, you're buying into wind farms because the two founders like wind power, right? So they've taken the assets of Google, which is an internet communications company. And by the way, they justify the dual class structure on the basis that media companies always have that. And the reason you have dual class is to protect the editorial integrity from the vagaries of the marketplace. So Google, a quote media company, which it isn't, a wind farm company now, which it isn't, an airline provider with hammocks, by the way, if you're in front of the CEO, which wasn't, your money's being used there. So ultimately, yes, they're very successful. It was a great idea. But at some point, when the shareholders give up control to a management group, you're putting an awful lot of confidence that they will not act in their self-interest to the disadvantage of you. And I think ultimately you're taking a terrible gamble that ultimately doesn't pay out. Look at Comcast. I could go down New York Times. I could go down the list of dual-class companies. But Conrad Black and Hollinger International, where the minority holders bet their fortunes, if you will, on the largesse of the majority holder, and in the end suffered tremendous loss in shareholder value because of the self-dealing that goes to accompany the dual-class structure. And I think that, in fact, is probably where Google ultimately ends up. And if the worst comes to worst, as a shareholder, you can take a nice hammock on the 767, wherever you happen to
But
go.
I think your point is well taken, but if I invested in Google at $108 on the day after the IPO,
Right.
it's $540. I'm happy with the 5 times the return. I can vote with my feet and move on.
As long as you sell it. but a lot of people don't. And Laura, as a trustee of TI-CREF, who doesn't buy and sell stocks, will buy Google because it's an index, and at some point, when everyone realizes the 767 blows up with someone in the hammock who sues Google for everything because they were flying using Go, then you've got a problem. I mean, the point is that the difficulty of dual-class stock is there's an accountability discount based on it. In other words, typically we have two regimes to control ineffective management: A, legal, right, you can sue them, and B, voting. You've wiped out voting in a dual-class structure. You're left with the legal. And the legal is really, really hard to enforce. Because if someone were to sue Google on the 767, they would come up with a really good argument, by the way, as to why the hammocks are appropriate for their executives sleeping better as they fly, God knows, all over the world. Needless to say, you could buy a first-class ticket on any airline for about 1/1,000,000th of what they put into that airplane. But they still can justify it down the road. And I think that's, you lose accountability. Will it be the end of the world? No. But on the other hand, talk to someone who invested in Hollinger International, which is Conrad Black's company. Conrad Black, the great media genius, ended up stealing half the company, went to prison for it. In the end, those who stayed with that company have holdings that are basically worth practically nothing, who stayed with it. If you got out in time, you're right, you did okay. But who's to get out? No one to get out. Yeah.
But, I mean, there is suspect largesse and requisite consumption at firms regardless, by management, at firms regardless of their share structure.
Absolutely.
The vote is used only infrequently, usually in control transactions, and meanwhile, it's useless. It's not like there's a daily poll and I say, yes, no more wind farms, or no more wind farms. But that vote is, I don't care about it. You know, I don't care about it. I think most investors don't care about it until it comes to a control transaction or some kind of share issuance. It's not designed to control purpose consumption. There are plenty of managers out there, single share class firms, that do things that offend my Protestant sensibilities, but the vote isn't a mechanism that allows me to do it.
And you're right, which is why governance advocates have been focusing for so long on A, director independence, and B, director equity ownership. But the flip side to that is open elections. And that's why institutions like TI-CREF are much more active than they used to be. And and that's why Ralph does things in majority voting. I mean, voting is an accountability mechanism for directors. But where you have the dual-class structure, there's no accountability to anyone. I mean, it's interesting. There's a whole bunch of stuff on say on pay at Google. And it's utterly meaningless because no matter what you vote or don't vote, because they control the vote, you have no input into it whatsoever. It's dual-class stock. Whenever it comes up, I say the dickens away from it because I know ultimately I'm going to get dinged by that management team, no matter how good they are. Every company I've followed over the years that has had that structure always ends up in unhappiness because the human condition, unfortunately, is to fill vacuums, power vacuums. And a power vacuum exists in a dual-class stock company, a la the founding party. You're right, voting needs to be more effective, and that's why we have majority voting, and that's why we have proxy reimbursement and other things to increase the importance of elections. But until elections become important, until you have independent boards, you're right. But I don't think you see the same abuses in a single-class company as you necessarily in a dual-class. Look at the New York Times, at the value they pissed away in the 30, 40, 50 years they've had that structure since 1969 or 71, 72. It's the late 60s. Look at Comcast. I mean, I could go down the list. Ford Motor Company, over and over and over, where you have that structure, unhappiness, unfortunately, ultimately results. When that great, brilliant genius either dies, passes it on to a stupid kid, or has a problem, that's the issue. Whether it's Google or God knows what else, sooner or later.
But I think he's brought up a really good point, which is how important is the shareholder voting compared to the other governance mechanisms, such as executive compensation, institutional investor monitoring. I mean, it seems like the voting has not been as effective over the years.
Because it hasn't been an open voting system. The system is such that you only have one choice. You can either withhold, which meant nothing until majority voting, Or today, with access or reimbursement, you have an actual legitimate ability to nominate a candidate. Or you have a hedge fund who actually nominates a director. But you're right, Laura, it's not as effective as it should be. I agree.
Well, shareholder proposals. I mean, it's not just voting for directors, there have been shareholder proposals that.
But they've had the
Until
same
recently, there was rarely a majority vote on the shareholder.
But they've done shareholder proposals that really had a big impact, whether it's director compensation. That's how equity comp for directors came about, was because of shareholder proposals. A guy named Bill Steiner, who was a one share shareholder basically, put through his resolutions for success and ISS successfully got into play. They have been really important in the way boards operate. They've been a real important signaling mechanism that have really pushed boards in the right direction, I think. More than, certainly more than we thought it would. Look at anti-poison pill votes, destaggering boards. You would never see destaggering until shareholder resolutions came around, hitting majority votes. And that's a big deal. That's a big shift.
Laura, that raises an outstanding question for us to pursue, which is, let me ask the panel, what are the important factors in corporate governance? What are the important mechanisms? Is it internal? Is it external? And which do you think is dominant? And since I'm still talking, I'll steal the market for corporate control as being one of the dominant ones and then let you follow up.
I don't see how you can, I don't see evidence that says one is more dominant than the other. And I think that's a real research question, is what are the important mechanisms and which one is really the most effective? And can you even say? And
how do they interplay with the international environment, where customs and laws and ethos and
I would say that we have some solution for US companies which will never apply for continental European, because market for corporate control is not here. I mean, if 99% of the company have a majority shareholders, you don't have that kind of threat of takeover. So, for example, in Europe, we are always trying to regulate more and more in order to prevent abuses. But probably you are making too much regulation. I'm wondering if it's worthwhile to do all this regulation, which becomes expensive for companies to comply with. Just to add one point, and also I can add a point to the against dual class equity structure, but you can probably realize that I'm against the dual class equity structure. Is that whenever you have dual class, you can make a wealth transfer between one class and another class, a wealth transfer between the two classes. The only way not to have wealth transfer between the two classes is to have one class. There's nothing to do with it. They've just accepted me a paper on financial management, which is on dual class voting. In Italy and in many other countries where we have a non-voting class, we give the non-voting class a veto power for resolution, for proposal which can harm this class of shareholders. So in case you want to cut dividends granted to them, for example, they must approve the dividend cut. Okay? And the law also requires a minimum equity quorum, which is 20% of the non-voting equity, which must approve the resolution. It's meaningless. I made a case study where the majority shareholders typically, typically owns also, let's say, 60% of voting and 21% of non-voting share. So he can approve whatever he wants. But I found a case where the majority shareholders was owning 20% of voting shares for media manipulation and investment, institutional investors controlled by the banks participating in the shareholder act. And moreover, hedge funds were not making their job. Why? Because hedge funds typically hedge from dual class wealth transfer by buying the same percentage of voting and the percentage of non-voting shares. Since they are hedged by holding the same stakes, then they approve whatever they want, because they don't care. They know in advance that they can be expropriated. They protect themselves by buying both classes of shares, and then they self-expropriate. They say, yes, I expropriate myself in this class because I gain on the other class. So even their behavior is not helping. And I really persuaded myself that you've got to have one share, one vote. No matter, there's no solution for it. Otherwise, you should regulate voting in conflict of interest. And you should exclude the votes when majority shareholders also own the non-voting shares. So you should exclude the vote for each kind of conflict of interest. But then you will have a very low turnout in our meetings. 1% of people will decide everything. So, it's not easy.
And thinking of the mechanisms and how they vary in different settings, I think your work illustrates that very well with executive compensation.
It does, but it also raises, I mean, what it's done for us, since we were looking at very high-level structures, if you want to call it, legal environment at the country level, what it's raising for us are these questions that I think are coming up here, which is, what role does firm-level governance play within these country-level structures? So, do they complement? Do they substitute? When do they complement? When do they substitute? That's something we're going to start looking into. We haven't. I know Renee has a paper with Andrew, and maybe with Craig Deutsch, where they were looking at different transactions. They were finding substitute, issues at one level of governance at the country level and complementarity at the other. I think those are issues that we will probably find, because it seems as though any one mechanism doesn't seem to work.
One size doesn't fit all.
One size does not fit all.